Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we look at third quarter mortgage market shares. We'll introduce you to the latest Neville Bennett opinion piece where he challenges the forecast that we will escape a housing price correction, and we'll update what has been happening with finance sector jobs and pay. Finally, we'll wrap up with what the other media are reporting. Subscribers to this website have access to our mortgage market share data. The banks are now reporting in with their detailed general disclosure statements, and these documents show who is winning the mortgage wars and who is not. As we've commented before, in a soft or declining market, fighting for market share is a zero-sum game. There will be as many losers as winners. For the months of July, August and September, we have seen the market soften markedly. In July and August there was still good growth in the mortgage books of about $1.5 billion per month, but this halved in September to only $700 million and is likely to have been soft in October and November as well. ANZ has reported its September quarter result, and it is a very good one, with quarterly growth of more than $1.4 billion. ASB, on the other hand, has come in way lower than has been used to, and they'll be quite disappointed. The other third quarter result we have is for Kiwi Bank, and they will also be very disappointed. Their book grew almost $750 million, but all but $100 million of that was for the HSBC book they purchased. Net organic growth for them was the lowest they've had since the December 2004 quarter. Kiwi Bank is a heavy advertiser, and you have to wonder why they're not getting better market penetration. Two recent reports argue that New Zealand house prices will retain their gains. Westpac predicts similar house prices in 5 years' time. Infometrics picks a 7% rise by 2010. But Dr. Neville Bennett has a different perspective, and we've posted his latest opinion piece to this website and made it available to our Just the Facts subscribers. His argument is that our house prices are going to decline soon. He suspects the professional analysts are being way too cautious, and that new factors are in play now that were not important the last time the heat went out of our housing market. Firstly, international demand has been important in driving up key sections of our market. And he asks, why would that underpinning hold when other international markets are declining? Secondly, he reckons that the benefits of a tight labour market and rising incomes will be far too small to overcome the holding cost rises of increasing mortgage payments. And he says, without rising capital gains, the investment benefits are evaporating, so many investors will act rationally and quit their property assets. This will be encouraged while fixed interest returns on cash are so high. Few professional investors choose low return options when faced with an alternative that is better. His viewpoint is well worth reading, and you can link to it from the menus on this page. If you want to be added to our subscriber list, just choose the register button above. The latest data from the IRD on pay and jobs allows us to examine the trends for the finance sector. Although this data is released with a one-year delay, it still makes interesting reviewing. We're able to drill right into the deposit-taking industry of the finance sector. Our charts are for the period from March 2000, quarterly, until September 2006, and the first perspective focuses on the growth in the number of full-time jobs in the industry. This trend shows the number of positions filled that have had someone in them for more than 1 year. It is the core employment indicator. And there has been good growth in this sector until mid-2005, after which job growth has been minimal. It is likely that outsourcing, especially of some back office and call centre functions, are the reason for this slowdown. But there has still been no net loss. We also track median pay rates in the industry. By tracking the median rather than the average, we effectively target changes for staff without distortions from either the high or low ends. And this clearly shows recent pay growth faster than most other sections of the economy. Both job growth and pay growth were faster than national averages, and worker turnover rates were well below national averages also, at least until the end of 2006. And finally today, a wrap-up of some other items of interest. The NZPA reports that Finance Minister Cullen says he supports the Reserve Bank's focus on fighting inflation, despite the impact high interest rates and the strong currency is having on exporters. Bloomberg is also reporting that he will allow the budget surpluses to shrink, even at the risk of stoking inflation through increased spending or tax cuts. In other words, I say I support the Reserve Bank approach, but what I am about to do is something completely different. Oil reserves for the Tui area oil field have been increased to 42 million barrels, 30% above the previous estimate and nearly half as much again above pre-development predictions. New Zealand uses about 60 million barrels per year, so this field contains enough oil for about 3/4 of 1 year's national consumption. You can get more news and start with Newsmaker Views on our news page. Join us again on Monday for the freshest finance news on the web. We'll see you then.